So we're going through the parts of the master budget, except not the cash budget. So the first thing is the sales budget. You have to have a place to start, so you figure out how many units you're going to sell. Production budget is based on that sales budget. So you have to do the sales budget first, because you have to know, okay, if I'm going to sell this many units, how many do I have in my inventory? How many do I need to make? How many will I have at the end, right? So you have to budget out that production budget. Once you know how many units you're going to produce each month or each quarter, however your budget works, you can figure out, okay, how many direct materials do I need? And that's just expected usage times the desired, plus the desired ending inventory minus beginning inventory. So you figure out how much I need of each piece of direct material for the number of things I'm making. And you have to allow for, well, I already have some inventory, but I'll need some at the end. I don't want to stock out and get to zero. So you allow for that when you do your direct materials direct materials budget. Of course, if you're doing production, you need some workers. So you're going to budget the labor, and you should have some idea, obviously from your previous cost adventures, what standard amount of labor is for whatever it is you produce. We haven't really talked about standards, but we will in Chapter 9. But you should know, after you read Chapter 9, how to come up with a standard and budget for that. So you have some standard that you can say, I know it takes an hour for my personnel to make 1 unit, so an hour per unit, something like that. Then the overhead, that's all that overhead. The individual man, I always worked in a department that was overhead, so my managers had to sit down and make their part of the budget so it could go into overhead, and then the overhead went on to become part of the overhead budget. So these support departments, all those people, they need to do their budgets first so they can estimate based on the sales, right? They know, oh, if we have this many sales, we think we'll have to make this many copies, hire this many people, they can figure theirs out. And so overhead budget becomes part of the operating budget based on all the little sub-budgets like marketing, accounting, human resources. All right. Ending finished goods inventory, right? So merchandise inventory or finished goods inventory, goods available for sale, however you're going to call it, has to go on the balance sheet, right? So at the end of your budgeting, when you figured out how many you're going to sell, so how many you're going to make, so how many you'll have left at the end, you'll have to figure out a cost per unit, apply it to that ending inventory. So now you have your inventory for the balance sheet at the end of the period. And then you use your cost of goods sold, right? So once you have ending inventory, you can figure cost of goods sold, right? Cost of goods sold is just beginning inventory plus goods manufactured equals goods available for sale minus ending inventory equals cost of goods sold. So now you've got your information to calculate cost of goods sold. You can put that on the income statement. You know from the sales, right, that you know what your revenues are going to be, so you can take that out and you can figure your gross profit. So we didn't really talk about these up front, but really these would have been done at the same time as the sales forecast, or once the sales forecast is done and you know how many resources you're probably going to need, you would do your marketing and administrative budget, selling and administrative, right? So you've got your income statement ready, you've got your revenues from your sales budget, you've got your cost of goods sold from your cost of goods sold budget, so now you can get your gross profit, or in this book they call it gross margin. Well, remember, after operating expenses, there's some things that aren't overhead. So you got to take out your marketing, your selling and administrative expenses to get to your income before taxes. All right. Research and development comes along, and it would be some other expenses, and you could do your complete budgeted income statement once you have all those things that are budgeted. We're not going to do a capital expenditure budget for our exam or our homework or anything, but you can imagine that you got to have long-term plans. I mean, you're hoping to grow and build as a company, so you think, okay, well, what Do we need a new factory? Are we going to need some new delivery van? Whatever it is you do. Some new scanning equipment if you're a doctor or something like that. So you have a capital expenditures budget, financial, long-term, more maybe, not going to worry about it in this class because we're more concerned with operations and the variances in operations for our budget. But, you know, it's a budget. You have to think about it. I want to talk a minute about static versus flexible budget. So you understand that what we've been talking about so far is we've pinpointed one sale, right? We say we're going to sell 1 million units in June, right? So that's a static budget. And then we go from there, we figure out 1 million units and we sell them for $1 each. That's $1 million. Then we need to go and figure out direct materials, direct labor, overhead, and figure that, right? So for 1 million units. So everything we're doing is based on this one number. But the reality is, you can do a flexible budget that provides a variety of levels. You can say, well, we feel like we're going to do 1 million. If we really do outstanding, we'll do 1.2 million. If it's a slow month, it might be 900,000, right? So then you would budget for each of those and work on that. Also, a flexible budget, after you get your actual activity level, you might flex the budget based on your actual activity so you can come up with your variances. Okay, so we call that flexing the budget. So in other words, I budgeted for 1 million and I came up with all my direct labor, direct materials, and all that stuff. And I actually sold 1.1 million. All right, so now I need to flex the budget and see if the differences, because obviously there's going to be differences from what you realized to what you budgeted. Are those differences due just because we sold more units, or was I wrong on some of the prices? So we flex the budget, and that simply means if I had known I was going to sell 1.1 million, what would I have predicted? Right? So using all your same standard costs, you're just flexing it to match what you ended up really doing. And that's where we get our variances. All right. So a variable budget could be prepared based on a bunch of different numbers. Flexible budget variances are generated by comparing actual budgets to the actual level. So we can use budgets to see if we're doing a good job or not, right? If I'm predicting something and it's turning out, that's good. If I'm predicting something that's not turning out, what's wrong? What did I get wrong, right? Because you should be able to do a good job. So here's a budget, right? And comparison with the actual. And we have what we call variances. Okay, so if you look at this, you'll see the first column is your actual stuff that happened. So we produced 3 million, here's our cost, here's our labor, right? We budgeted 2.4 million, here's our cost, here's our labor. What's the difference? So that difference is what we call the variance, all right? So next chapters we're really gonna discuss them, but I just want you to sort of get the idea now about variances. When there's a difference between budgeted and actual, we want to know that. So, direct materials cost, $927,300. Budgeted, $624. All right, so that's a variance. It's a variance of $303,000, right? So that's it. You just subtract them, and what's the difference? Well, it's $303,000. So you got an F and a U over here, and F stands for favorable. Not fixed, favorable, and U stands for unfavorable. So what makes favorable and unfavorable is not just was one bigger or smaller, it's was that difference, was that variance profit increasing or profit decreasing? So if you look at that first line, you budgeted 2 million for, you actually made 3 million. Well, that would increase profits, right? Because you would have had more and sold them, so that's favorable. Let's look at the next one, materials cost. So again, you increased the cost over the budget, so it's still a big difference, but that's unfavorable because expenses decreased profits, right? And then if you look down at the power, you budgeted 48,000, but you only used 40,000. Even though that's a negative variance, it's still favorable because that was an expense, right? It's good to have your expenses be lower. So that's how favorable, unfavorable works. And when we flex the budget, we can start to determine other variances. So we're going to save most of this for chapter 9, but it's important to understand that we have a static budget, right? We predicted we would sell 2,400,000. What we actually sold was 3 million. All right? So what I can do is flex the budget, the second column, flexible budget, which is where I take the numbers I used to create the static budget, in other words, the cost per unit, and I say, well, what if I had known that instead of making 2,400,000, I was going to make 3 million? What would I have predicted? Then I can start looking at my variances in a way that tells me where I was off by volume, right? It's, well, this is the difference you're off because of volume, and this is the flexible budget variance that you're off that's not because of volume, it's because of something else. You did a bad job of guessing materials. So we'll get into that in the next chapter, but just understand that a flexed budget is where you say, here's my static budget, and I thought my materials would be this much per unit. What if I had known that they would be that I would make 3 million? What would I have predicted based on that? All right, so I want you to skip cash budgets and go out to the behavioral dimension of budgeting and read about the little things people do to use budgets to encourage managers to do a good job, and how managers kind of cheat by building in slack. So read that stuff. Budgeting can actually encourage bad behavior in organizations because people are trying to meet goals or meet budgets, and they're not actually thinking about the organization as a whole. So just be careful when you do budgeting. So read that stuff. There might be a couple questions about that. Good budgets provide feedback frequently. They provide non-monetary incentives too. It's participative. You don't just slam a budget on a person and say, here, do this. They have to have some say. It has to be realistic. You have to have, if you're expecting to grade a manager based on their performance on their budget, they have to have some control over those costs. Because if you just say, meet this cost, but they don't have any choice of where they buy from or something like that, that you're setting yourself up for bad behavior. And you need more than one performance measure. All right. And what I'd like you to do now is go try to work 8.36. You can watch the videos. Then try the homework and the quiz, see how you're doing. If you have some questions, get in touch, okay?